Okay, good afternoon everybody and welcome to the latest Urban Living webinar. Today we are going to talk about investor sentiment a year into the pandemic. One of the first sessions we did in this series was looking at investor sentiment when the whole COVID situation was quite new and nobody knew what to expect. So and we spoke to some investors then about how they felt. And today we're going to talk about how things have changed in the intervening year. Today's session is sponsored by Cinevision, and to talk to us about those and tell us what those guys do is Dr. Stefan Plesser. Stefan, welcome.
Yes, hi. Very happy to sponsor this session. My name is Stefan Plesser. I'm Managing Director of Cinevision. We are providing digital quality management services for buildings. That's our contribution to achieving ESG goals. So we support buildings in actually achieving the performance they intend to have, and we make building performance contractable. We consider this a very important aspect of achieving our ESG goals, that actually those goals become part of contracts. And of course, I'm very curious to see what the investor's perspective can tell us about this after 1 year of COVID. So it's a pleasure for us to sponsor the session, and I'm excited to be here and to listen to the panel. Thank you. Have a good time.
Thank you, Stefan. And if you'd like to find out more about Cinevision, you can see Stefan's contact details and the company website in the chat. Now, this session is one of a webinar series in the run-up to the Urban Living Festival Live, which is an event we're launching in July at Tobacco Dock in London. This event is focusing on the convergence of various hospitality and real estate asset classes, mixed-use development, and the future of the way we live in cities. More details about that in the chat. So everybody who isn't one of our speakers will remain auto-muted with their cameras off. We're going to have about a 45-minute discussion with our panel. If you have any questions, please do submit them in the chat or the Q&A, and we'll try to get around to answering as many of those as we can towards the end. A recording of this session will be emailed to everybody who has registered. My name is George Sell. I'm Editor-in-Chief at International Hospitality Media, and we are the publishers of 3 B2B news websites for the hospitality sector, and we're also an event organizer. Now, this webinar series has been sponsored by Res Harmonics, and we're just going to see a 1-minute video to find out more about them.
Res Harmonics is 100% dedicated to service departments and co-living, bringing together all the tools you need to drive performance and deliver a great guest experience. From channel management and direct bookings to finance, housekeeping, maintenance and customer journey automation, whether centrally or on the move, the platform consolidates all information into one system, saving you time, improving communication and maximising business performance.
So thanks to Res Harmonics for sponsoring the series. If you'd like to find out more about them, then Steve Dow's contact details are in the chat. So before we get started, I just wanted to give the conversation a bit of context and share with you some news stories that we've run on our websites over the period of the pandemic, just to show that there are plenty of deals still going on across all sorts of different asset classes. So most of these are from the Service Department News website, which also does cover sort of peripheral asset classes. So you can see there's good sized deals being done across extended stay, across the student accommodation sector, across co-working. And only last week, the Blackstone and Starwood JV to acquire Extended Stay America for $6 billion was announced, you know, the biggest deal in the space for quite some time. There's some stories here also from our Boutique Hotel News website. So as you can see from one of those, UK hotel investment has declined 70%, but there are still deals being done. And on our short-term rentals website, quite varied type of deals here for different sorts of asset classes, from everything from RV share, which is a camper van rental company essentially, to glamping, and a huge deal for RealPage, which is a software provider, a $10 billion deal there. So we have a great panel of experts with us today. I'd just like to ask them all to introduce themselves briefly. Their contact details and LinkedIn profiles will be in the chat. So if you'd like to carry on the discussion with them after the session, then please do. And let's go from left to right. So Laura, welcome to you. Hi.
Hi. Thank you for having me. Yeah, my name is Laura Brinkmann. I'm a VP in Brookfield's European private equity team. We look after our real estate portfolio, which is slightly in excess of 14 billion AUM. And amongst that, we have a large office portfolio, as well as a number of European platforms, particularly in the student housing space, as well as the service apartment and hotel space. And then I think most people will be familiar with Center Parcs UK, which is also one of our investments. And that's, yeah, looking forward to this conversation today.
Thanks, Laura. Niklas, welcome to you.
Hello, thank you, and happy to be here. My name is Niklas. I represent NREP and Noli studios. NREP is a Nordic real estate investment company, and Noli Studios is a operating platform fully owned and managed by NREP. And we operate in service departments or service living. And we have 2 sites up and running at the moment. We have a 3rd site under construction and an extensive pipeline of sites coming up in Finland, which is our home market at the moment. We're also looking at opportunities to expand beyond Finland.
Thanks, Niklas. Henri, over to you.
Hi there, my name is Henri. Thanks for having me. I'm the CIO of Hostels, which is the largest European hostel operator and owner. So we operate as of now 39 assets, another 3-4 confirmed in the pipeline, of which we own half of it. The other ones are on long leases. And yeah, so I manage all the new acquisition, and I'm in charge of all the real estate basically in our platform.
Thanks very much, Henri. And last but not least, Will.
Hi, everyone. I'm Will Deere. I'm a partner at Crosstree Real Estate Partners. We're a UK-focused real estate private equity investor. We've got a portfolio of about $1 billion across about 10 existing investments. It's a pretty broad remit, from kind of standing investments, developments, corporate situations, as well as even sort of sourcing debt for other borrowers and developers. Pretty sector agnostic. So I'd say about 1/3 of our portfolio is hotels. We've got a couple which are sadly closed at the moment, but reopening shortly. We've got the Standard up in King's Cross, the Mammoth Shelter in Shoreditch, near Tobacco Dock, if you're looking for someone to stay in July, as well as the one hotel in Mayfair, which is under development and opens in early 2023. As well as hotels, we've got some office, residential, retail and student exposure, and I guess kind of on tune with urban living. We're kind of a London-focused investor and developer. So yeah, certainly very interested in monitoring all of the sectors that kind of George covers.
Thanks very much, Will. Well, as you say, you're a sector agnostic organisation. Let's kick off with you by asking, over the last year, which asset classes have been the strongest and the weakest performers, both in your experience and from observing a broader range.
Yeah, well, I guess, I mean, to your point on your earlier slide about sort of hotel investment being down 70% and generally transaction volumes being relatively muted, it's been a little bit hard to draw kind of clear conclusions. I guess what I would say is, I mean, COVID's probably been less of a sort of change agent and more of a sort of accelerant of previous trends. So there's been a lot of chatter about industrial and residential really kind of powering on over the last year. And I guess the other end of the spectrum, certain sectors, and it's dangerous to generalize, but retail in particular, which has had a much kind of tougher time of it. So I I think some of the trends we were seeing play out before have sort of continued and probably just, as I said, accelerated over the last year. I guess, in respect to hotels specifically, there hasn't been a sort of ton of distress yet. The handful of sort of well-publicized distress situations, probably frankly more situations that were over-levered before we went into all of this, or just kind of underperforming operationally, and so forth. So, I think, and I think now we can sort of see light at the end of the tunnel, and generally leverage is not that high. I don't think we're going to see sort of a ton of distress necessarily in hotels. But look, I'm nervous to sort of start labeling too many kind of new structural trends 12 months into COVID. But yeah, so I'd probably sort of slightly sort of sit on the fence and say it's sort of playing out of trends we were seeing kind of before the pandemic accelerated more.
Niklas, how about you? Across the NREP portfolio, which have been the strongest performers?
I mean, we do operate in several different asset classes, and I mean, kind of the same sentiments as Will was drawing upon. We see that living on a broad term. I mean, when we talk about residential and co-living, I mean, those are faring pretty well. And another set of assets that are doing very well in the pandemic has been logistics. And then when we look at the weaker performance in retail in particular, and then offices to some extent, and especially with retail, I mean, we can see the behavior being, I mean, during the pandemic, it has been amplified, or the trend that was already going before the pandemic has been amplified during the pandemic, which means that the traditional retailers are more distressed than before.
Mm-hmm. Thanks, Niklas. As the editor of Service Department News, I'm slightly biased, but it's been incredible to see how the extended stay and service department sector has performed over the last year. Laura, do you want to talk to us a bit about how Eden and Lock has fared, and your plans going forward, and how they may have been affected by the pandemic?
Sure, with pleasure. Eden is our poster child investment, and I said this on a different panel. If you had asked Brookfield 12 months ago, going into, or at this point 12 months ago, whether or not we were as confident around performance in the service apartment sector, when the entire world was closing borders and travel was halted, and our classic customer just wasn't non-existent anymore overnight, we wouldn't have been very bullish. And so Eden has demonstrated an ability to pivot strategy and change narrative and go to market and position themselves in a way that really catered to the little demand that was available. So overall, the business, despite being like consolidating a few smaller operations into the larger assets, we have closed the year with 65% occupancy, albeit at a massive discount to our usual ADR, but nevertheless, we had a number of assets that were making money and breaking even against their operating cost, and that was fantastic. We would have never assumed so. So we are now very positive about that asset class. We got very lucky with the management team being very supportive. So we own the operating platform, their development capability, as well as the PropCo. And so it enabled us to manage the vertically integrated platform and have no misalignment between owner and operator interest, for instance. So going forward, we're definitely keen and looking for opportunities to grow the product. I think COVID has helped us create awareness around a product that previously was discarded as, well, I'm not relocating, or I'm not, like, I don't want to stay in a corporate, don't want to stay in corporate housing. I want to stay in a sexy hotel room. I want to have the benefits of a hotel. But usually people discounted or didn't appreciate the fact that they would get, a 24 square meter room. Now they can have a 30 square meter room or larger with the added facilities of a hotel. but still have the sense of living there and being self-sustainable, whether or not you ever need to self-isolate, and I hope we don't. I hope we're soon beyond that. Or if you just want to go for a longer weekend with your partner, with your family, or on holiday, like this, I think this product is here to stay and is here to take up some market share from hotels.
Mm. And the lock development pipeline is really strong, and you know, throughout the year that there have been additions and announcements to that. Does that mean that landlords are more switched on to the extended stay product? Are you getting more potential deals across your table now than you were before the pandemic?
So in abstract, the answer to your question is yes, absolutely. So I should point out that for Lock, we are predominantly looking to grow with our own equity and our own money. So we want to own the asset, and we are seeing deal flow, although I have to echo what Will says. We've not really seen much distress and too much capital chasing the same deal. So I think going forward, hotel financing is very difficult to obtain right now. Like, you do get it, and we do see it, and our pipeline is strong. So we have had a number of conversations with lenders, but I think it's going to differentiate the type of investor chasing hotel and who has the capability, because you do need to put down a lot of equity right now, and you're often forced, they're forcing financial covenants and other things upon you, or guarantees, where, you know, these are non-starters for many investors. So yeah, so Lock has a huge pipeline, and on the asset light side, we've seen a tremendous amount of options, because obviously there've been portfolios, there've been single leases that just couldn't service their rent roll anymore, and have gone like either belly up or just before the process, and that's something we are evaluating. So we're growing through both models, but yeah, like it has to work for us. And so lease levels have only partially come down in some places. And again, like associated guarantees, because landlords are scared and they want security, and they don't want to find themselves in this situation again over the next 18, 24 months. So that's something we need to work out. Like we have great covenant, but we're not interested to secure really long-term punitive guarantees.
Yeah. Thanks, Laura. Henri, how has the hostel sector performed? I mean, I think people are quite bullish about it returning fairly quickly as the youth traveller are less risk averse than those of us who are more seasoned. But how have you seen performance, and how have your plans going forward been affected?
Yeah, I think to start with, I think it's important to differentiate a bit, because we definitely a hostel business, but looking at our room mix, actually only 20% of what we have is a poor bunk bed product, and the other ones are mixtures of normal double bedrooms, or what we call family rooms, which is a double and a bunk. I think that has for us been very important during the last year, because this has been helping us actually to, in the few months where we could trade, actually to attract demand. Meanwhile, I know from a lot of other hostel businesses that are poor bunk bed businesses, and often also have shared bathrooms, etc. Those have been really problematic for hostels. So I think we were lucky from that side also, that we have always ensuite bathrooms, so we kind of could trade as a hotel business as opposed to a pure hostel business. And I think that made a huge difference for A&O during the last year. And so I'm pretty sure that I know that normal, like a more traditional hostel business, was suffering relatively much more than we did. So going forward, I think it's a bit in line with what Laura said and Will. I think it's like always, the businesses that were doing well before COVID most probably will come out of this. Obviously, with a bit of side damage left and right, and everybody had to put heads down and had a hard year, etc. But there's luckily a bit of light at the end of the tunnel, and I think we'll come out stronger. I think from an operating perspective, I think a lot of things have been challenged during that last year. We had more time, on our hands. So obviously a lot of people, it was the opportunity of a lifetime to sit down and reflect on your business model. What changes can you do? Go really through all the cost lines. I think financial controllers know now what the bottom-up budget is again. meaning, you know, going through all the cost lines and really questioning and challenging everything. So on that side, I think all the successful businesses will emerge stronger, but the ones that were struggling already before, most probably, you know, those are the ones that you will see, you know, continue to struggle even more, and I think ultimately seeing them on the market in some, you know, sort of shape in a transaction. So yeah, we are very optimistic, because our business model, as you rightly say, is on the budget spectrum. It's very domestic focused, and is the young traveler. So we all know among the youngsters, you know, they, you know, as soon as the door opens, they just want to go and leave and go on holiday. So we're quite optimistic looking forward, but still there's a few very hard months in front of us. I mean, nothing to hide. And yeah, just make our way through it, basically.
Yeah, thanks, Henri. We'll talk a bit about potential distressed opportunities on the market shortly, but I'm interested to know if the pandemic has forced you to change your medium and long-term investment strategies, or is it just a case of riding this out until normality resumes? Will, would you like to kick us off on that one?
Yeah, sure. I don't think, I mean, look, as I said, we're sector agnostic, so it's more sort of opportunity and deal led. So I don't think it's a case of suddenly saying, oh, we're not ever going to do hotels again because we don't know when people are going to be flying internationally or whatnot. It's probably more about, you know, where you can spot opportunities to actually, you know, buy stuff that you wouldn't otherwise during the cycle be able to kind of compete. And you know, and I guess, yeah, a couple of examples that Crosstree have done over the last year or so in, you know, pretty, you know, in normal times, pretty well-trodden sectors. So we did our first student deal in East London, which would normally be a kind of pension fund type investor who would be buying this stuff, but it was just completed with a developer who was, you know, whose lending bank had kind of, well, their lending relationship had sort of fallen through, so they're keen to sell, and they had no track record. No one wanted to take a sort of punt on whether students were going to come in September, and in truth, not that many did, but they'll come next year, and it's already booking up nicely for next year. But so that's a kind of example of the sort of thing that you can do through COVID, I guess, which otherwise, you know, it's a gain. So yeah, in a roundabout way, saying not really changing strategies, but trying to find, you know, the interesting situations and whatnot. I guess we also did a mezzanine loan on a hotel development in Marylebone, on the Marylebone Lane Hotel, which again, typically there'd be a long queue of mezzanine lenders who'd be keen to do that. They were out of the market, not knowing, you know, how long the pandemic was going to go on. We actually took the view that if you've got 3 years of it, you know, of development, it's actually quite a nice time to be sort of under scaffolding, and I'm sure the world will look better in 2.5 years from now than it did when we did that loan. So I think it's a case of just finding situations. I don't, you know, it's difficult to make sort of rash structural changes to your investment theses through these times.
Thanks, Will. And Laura, at an organisation the size of Brookfield, how has the pandemic changed investment strategies there, if at all?
Yeah, not very much. I mean, we're long-term investors in general. We are mid into our 3 strategic funds with plenty of fund life left. So luckily we're in a position where, and this has been some exceptional deals we have seen, where we are not at the end of a fund life. We're not forced to dispose of anything. We have plenty of time to ride out the market and see whether or not at this point our investments stabilize. Now on the acquisition front, we were previously busy in all the sectors that have been mentioned. You know, we love hospitality, we understand it well, but pre-COVID it was impossible for us to find pricing that worked for our opportunistic capital. We are very invested and active in the student housing space with our 5 European platforms. So that's a space we remain active in, and we actually see a lot of small individual assets repurposed from office or hotels, and those are usually some that are that were under capex, understarved in locations where their use wasn't working anymore. So that's it's not Brookfield ticket size, but within our portfolio companies, we're starting to see quite an influx, and they're building their pipeline. So that's exciting. And yeah, what I said earlier with regards to hotels, we are hopeful that there will be opportunities that work for us, either because of ticket size or complexity of structuring, or because of the ability to put down a lot of equity work with different, like with capital stacks that others may or may not have available too. So we can be creative on that front, but when it's a single asset that is VP in Barcelona or Amsterdam, like our capital is not the right fit for that, unfortunately. There are too many out there.
Yeah. Well, I don't know if you've seen it, but this morning's Deloitte Hotel Sentiment Survey said I think 52% of those polled weren't expecting demand to return to pre-COVID performance till 2023. Now, a lot of people are saying there isn't much distress on the market at the moment, but I mean, if we're 2 years away from getting back to normal demand, do you foresee much distress coming onto that market, and is that something that you'd be interested in?
Yeah, well, I haven't seen that survey, which I mean, I guess the other thing to bear in mind is, these surveys will talk about kind of revenue getting back to 2023 or whatever. You got to bear in mind also, by then you've had three, even if it's a, notionally a employer's market, you're going to have 3 years of minimum wage growth across most countries. So that's kind of another 10% on your kind of payroll. And, the supply pipeline that was actually pretty strong given the kind of benign, wider environment of the last 10 years, that's kind of, provided another kind of 3 years worth of new hotels that will all basically be reopening in earnest kind of in a year or two. So there's definitely quite a few headwinds. There's also quite a bit of capital out there. So, I mean, if I think about kind of, conversations we've had in the industry where, owner operators or whatnot who might be kind of challenged in the current situation, they're not being put under pressure by their banks. If anything, they will end up getting kind of financing solutions, with maybe, more structured kind of scenarios where someone puts some mezzanine in, or, just slightly more, I guess, less typical kind of traditional senior lending type debt. But I don't see a slew of kind of distressed situations coming onto the market. I don't know if any of the other panelists have a view on that.
Does anybody want to pick up on that?
I partly agree. I mean, I think the stress is definitely there in the operations. I mean, it's undoubtedly because we have also to make also a differentiation between the propcos and the opcos, right? Where does the stress sit? But in the opcos, the stress is there. I mean, you can't, it's not possible to have no distress after a year of nearly no revenues and still, even if you manage your costs well, you still have ongoing fixed costs hanging around there. So it's been a cash drain year for operators. It's just a sheer reality. So I think what Will said, it's true. I mean, the banks are still there. They're supporting and etc. It's just a matter to see how long, but at the same time I think some opcos have been on the market. There's been some opco deals out there, and that were distressed deals, just because those opcos have maybe signed very aggressive leases over the last years and just had to pay the price for it. And so if there were investors that were happy to take that risk, and maybe also going in, to restructure this lease, etc. So I think in the opco world, there is definitely distress, and there are opportunities around on the more real estate side. It has not really figured through yet. So we've seen a few groups maybe selling one of their crown jewels just to generate cash. We've seen a few of those throughout Europe, but on the real estate side, also for myself, I haven't seen massive distress yet.
Thanks, Henri. So three of you represent companies across numerous asset classes, including office. To what extent do you think that people's working habits have been changed permanently by the pandemic, and will that result in you reducing your exposure to the office market, or will you convert some of your traditional office property to more flexible office and co-working space? Niklas, would you like to kick off with that one?
Sure. Well, I mean, when we talk about offices in general, I mean, we can see that prime office locations will still be in high demand. Non-prime, subprime locations again might fare, I mean, slightly worse, at least for the time being and for some time into the future. And if you think about, I mean, the behavior, I mean, may then be travel or other. I mean, business travel will likely resume, and it will go on a path of growth which will be similar to that before COVID. But it's a question of how long it will take until we get back on that growth curve. I mean, we will continue seeing I mean, people, I mean, working over Zoom and Teams. But I mean, as soon as there's going to be a possibility for people to travel again, they will travel, because I mean, people want to meet each other. If you talk about, I mean, trade shows or seminars, that has been completely dead for the past 12 months, and it's probably going to be dead for quite a while still, and it will resume, but likely, at least, I mean, in my opinion, we're probably going to see a lower volume than before the pandemic. So I mean, and when we talk about, I mean, whether we start, I mean, converting offices into the different shape or form, I would say that I mean, while 12 months that we've now lived with the pandemic, I mean, from a human perspective, that's a long time being isolated. But I mean, when you talk about real estate, I mean, that's a fairly short time still to see any bigger trends emerging. So I would not make any more detailed predictions about that yet, at least based on this information that we have at the moment.
Mm. Laura, you mentioned earlier that Brookfield are pretty keen to get staff back in the office. Do you think that is going to be representative of most big institutions, and do you think the predictions of the death of the office have been overplayed?
Yeah, so I mean, it's definitely a Brookfield view that the death of the office is overplayed. We don't share that sentiment for a number of reasons. So I do think that behavior of us all may have been changed through COVID, and that we will take up the benefits and flexibilities of working from home at our leisure. And I don't think employers can afford necessarily to no longer offer that. But in my personal experience, everyone I've spoken to and what I've seen on the news, people are hungry for contact and be able to be with their team or with their peers, because something that we've all experienced is that while video conferencing is great and it is definitely much better than just teleconferencing, you cannot pick up the sense of a pulse in a business, in an organization. You cannot gauge how leadership direction translates into actions through a video conference. It takes away all of the coffee area chat and the lunch that you pick with a colleague, or the ability to read body language. And so I think my personal opinion is we're all starved for that. Now, and at the same time, one thing I'd like to say, in the last 10 years pre-COVID, almost every employer on the planet that had their individual employees in the office worked on creating a culture or making the workplace as attractive as possible. Because besides pay and prestige of working who you work for or getting the dream job that you want, one major element of trying to attract and retain talent was to create a workplace that was seamless between and providing for a work-life balance, with all sorts of services that were offered at your workplace, flexibilities, again, community feel, co-working, ability to bond, meet new people. So we have in many places, these attractive environments that were the sole factor for people to go and work there. So again, I don't think that's going to go away. If anything, I think we're going to get to a point where people are hungry and keen to engage again, but in a different way. Now, for us as office tenants, I can only echo what Niklas said. We are very invested in prime real estate, really top grade office buildings. So we have long leaseholds with very strong tenants, which is also something where there's no fluctuation in that. We might have less physical population going in and outside of the building, but we don't have tenants that are now terminating leases or saying, well, this is done for us. I think at most you might see a couple of such individuals reducing their desks for the space that they have, because people will be more remote and occasionally more working from home. I don't see top grade office and the type of work environment that I was previously talking about going away. I think it's the subprime, sub-quality office that's going to suffer, and it may be repurposed. But yeah, that's our view. So we are strong on office, long-term investors, have been for the last 30, 40 years in New York, in London, and that's not going to change.
Thanks, Laura. Niklas, go ahead.
Yeah, actually building upon what Laura mentioned about the sense of community, and you can talk about that from the office perspective. That, yeah, sure, absolutely. I mean, people I mean long for the communal feel that they can obtain from the office environment. I mean, just having contact with your colleagues, but you can also translate that into the service living or the co-living, I mean, segment. Whereas, I mean, the pandemic has I mean, it already showed us last spring, and it has grown stronger further. I mean, during the past 12 months, that I mean, while there was some initial worries about, I mean, would the isolation part, I mean, by people isolating them from each other, I mean, and keeping each other safe and themselves safe, would that somehow stray people away from I mean, being attracted to co-living solutions? But actually, the opposite was true. So that actually amplified further the need that people have to belong, to be part of a group, to have contact with other people. So that is true both from a living perspective and from a working perspective in service living. I mean, operations as well as office locations.
Thanks, Niklas.
I guess a couple of other thoughts I just add to that. And I'm a big believer in the office, notwithstanding the fact that, you know, particularly in big cities like London, where most workers actually live outside of the core for just affordability reasons, so they have quite long commutes. You know, the benefits of working from home a couple of days a week will give you sort of 4 or 5 hours of extra time. I can see why that, with happier employees and you know, CFOs who think they might be able to organize workforces to work on different days in the office and therefore save space. I can see that there is some rationale for. Anyway, I think at least all of us office landlords keeping an eye on those trends. That all said, I guess why I'm also a believer in the sort of office story going forward, for all the good reasons I've mentioned, collaboration, culture, but also something we've really struggled with is with some of our kind of younger colleagues, just learning by sort of osmosis, you know, training them up. And we've noticed it's been tougher over the last year compared with the sort of previous cohort, just because it's not the same trying to teach someone over Zoom or on a phone call, you know, how to get up to speed on the job. I guess one other point I'd also add is, I think, you know, we've talked a lot about kind of sort of high amenity, well-serviced offices, and I think that will continue to play in offices. And I think you'll actually see an increasing trend towards sort of service offices where tenants also have extra flexibility. And you might start to see, as we've seen in hotels kind of 10, 20 years ago, much more kind of management contract structures on offices. So actually, instead of landlords taking a 5-10 year lease, they'll actually say, well, I can get a higher yield. And frankly, you know, there's a little bit more volatility in my income, but I think I can keep this building 80 to 90% full. So it's going to be, you know, within a certain band of kind of bottom line income, and actually start to run these things with external brands and managers who can kind of, you know, drive yield higher than higher than where you are kind of on a traditional lease basis, and that'll also work for the tenants. And I think there's probably kind of, you know, strong fundamentals for tenants wanting to shift onto those more flexible models anyway. So I think you'll see a sort of hotelization, not just of the product, but also of actually the kind of operating strategy, if you like, for landlords.
Yeah, thanks, Will. Sticking with you, one of your marquee assets, if you like, the Standard, is a converted former office building. So are you seeing any interesting repurposing opportunities coming to you in the shape of former office or retail buildings?
I mean, yeah, taking a city like London, which probably pre-pandemic it varied to city versus West End and Canary Wharf and whatnot, but it's, you know, availability rates in terms of empty offices was probably less than 5% of sort of total stock. It's ticked up a bit, but it's probably kind of, you know, mid to high single digits now. And most landlords still feel pretty good about what's a relatively constrained supply pipeline. So generally, I think the sort of mood music amongst office landlords is not, you know, in any way kind of, you know, concern or negativity. So I don't think, and I'd be interested to hear if any of the other panelists have heard otherwise, I don't think I've seen a single like office repurposing opportunity yet, certainly in the UK so far through this cycle.
Okay.
I've seen there's a bit on kind of other sectors. I mean, it's more frankly at the land site stage, right? Because that's where you can obviously change things. It's a little bit harder figuring out what you do with the department store once it's built. But, you know, we're seeing sites that were consented for hotels that are shifting to student and to what Niklas touched on earlier, kind of various different residential use classes. So more co-living as well. There's definitely like more shift towards kind of wider living asset classes, but I haven't seen kind of existing office buildings.
Henri, please go ahead.
Yeah, I mean, we at ANO before the pandemic, we were sometimes I say kind of conversion champions. So I think in a sense that most of our assets that we took on board were in some sort of form or shape a conversion because of pricing level, etc. was the only way for us to still manage to obtain the returns we wanted. But that meant that also that we were very high up on the risk curve. You know, sometimes, you know, all this planning and change of views, etc. is always a lengthy process. It's always full of risks and yeah, often driven by politics, etc. So it's very complex and it takes a lot of risk and often much more time than you think anyway. So I think from our perspective, so even if there were to come more opportunities now in the market, I think we've changed our strategy, at least for the medium term now, or the short and medium term, that we'll focus solely on existing hotel assets going forward, because I still believe there will be those opportunities now coming up more often at pricing that is actually attractive. So we don't need to take that risk anymore that we were prepared to take before the pandemic. So even if those opportunities were to rise going forward in kind of, you know, B or triple C location, whatever you want to call them, I think we at the moment where we are, I think we believe that there will be enough hotel opportunities for us not to need to go into conversion opportunities.
Thanks, Henri. Niklas.
Yeah, what we have seen, I mean, has been that obviously, I mean, due to the stress that the traditional hotel operators have been in, I mean, that we've seen a lot of projects that are I mean, moving along in the direction where there were assets that were supposed to be operated by traditional hotel operators, seeing those put those plans on hold, which means that has opened up new opportunities for I mean, other operators such as co-living or service living operators to kind of like, I mean, seize upon opportunities that weren't open to them prior to the pandemic. So we've seen that shift, but the actual purpose of the asset has not changed per se. I mean, it's still, I mean, an accommodation asset. I mean, it's just a question of the operator being slightly different. The only conversions that we've seen from offices into some other purpose has been plans that have been there in place or going forward already prior to the pandemic. So there's been no clear shift on that in the past 12 months.
Thank you. Will, you mentioned department stores. I mean, there are a few department store conversions happening, but in the UK, but I don't believe there are any in London. I think there's a former Phoenix store in Leicester, which is being converted into an apart hotel. Hampstead is converting a former Debenham store into a buy-to-rent development. Are they particularly problematic in terms of the building footprint? I mean, would it be a case of gutting the building completely to convert it to a new use?
Unfortunately, I haven't had to look at it too much, but I think the challenge is they're quite deep floor plates. So, I mean, if you want to give every hotel room a window, then you've got to sort of bore through the middle of it often. Yeah, I think they're, I mean, I think in London, the ones that probably have come back, and there's quite a bit of space on Oxford Street and you know, of former department stores, and it's either being converted into offices or it's kind of, at least pre-pandemic, kind of, you know, competitive socializing and that kind of thing that actually was paying sort of reasonable rents. So yeah, that's why I think we have, and I'm not sure exactly, there's probably planning connotations as well in London that are probably a little bit tighter on it.
Yeah. Laura, you touched on this earlier. Has the pandemic made you think differently about owner-operator relationships, lease structures, excuse me, and so on? Does it make more sense now to have the OpCo and the PropCo under the same ownership?
I mean, with the exception of office, for us, that's been our strategy for the last 5 years. And so we feel affirmed. I mean, we've acquired Center Parcs and Student Roost and GMG and International Campus and Eden, in which we always had the OpCo and the PropCo. So I previously said, and this is probably the biggest takeaway for us again coming out of the crisis, is the benefit of having that relationship or ownership structure is that you don't have misalignment of communication and interests. So we are able to control and influence and align these ahead of any consequences where you then have to like plead or negotiate and sort out the mess. So I don't think the lease model as a whole is gone, because there are many investor types and types of capital that rely inherently on that structure. I think that people might be much more cautious going forward with regards to covenants of certain players and whether or not they are signing up to guarantees and liabilities that they can actually honor, or for instance requiring collateral associated with that. So yeah, it's our preferred structure.
Mm-hmm. And in the instances where you own the real estate but not the operating company, how has the last year kind of redefined your relationship with your tenants?
I mean, so in Europe, I'd have to lie right now, but I don't think that's very much the case, where we have other tenants. So we do have one hotel in Germany, and it has led to exactly that problem. So we are in negotiations to try to rectify what is effectively in writing and see whether or not the relationship can help with that. In the US, I know we own a lot of branded hotel real estate, and so they are very different assets sizes. So, you know, north of 500 million worth of GAV, short of $1 billion type of GAV. So we have quite material influence as real estate owners when dealing with the brands, for instance, and or lease the like operating partners. And it has forced everyone to come to the table and just revisit as to whether or not the structure is suitable for the crisis and the immediate response after, or whether or not it's a future-proof model. So, you know, unfortunately, you know, brands are asset light, so there is no skin, like you can't demand any skin in the game or trying to make up for some of the losses that they haven't, like you have collectively incurred in COVID. But you can certainly exercise leverage and try to work with them on putting in place a more attractive structure that allows you to recoup some of the losses.
Mm-hmm. Niklas, does that tally with your experience at NREP?
Yeah, well, I mean, we actually have a similar setup regarding the OpCo and the PropCo. So we essentially it's a NREP managed fund that owns the PropCos, and then an NREP owned company acting as the opco or the main tenant. So having I mean control of both of these, again to echo the sentiment of Laura, that you I mean having these aligned, I mean it does not create a conflict of interest in that sense. I mean, you can make more controlled decisions. I mean, you can actually instead of, I mean, acting in a panic kind of way, and you can wait and see and do a more controlled response to the shift in the market dynamics or the supply or demand or whatever the issue that the crisis brings forward. What we have seen, obviously, is that I mean that we do have other tenants in the properties as well, and I mean especially when you talk about, I mean, restaurant operators who have been forced to lock down by government issued mandates, or I mean, or gyms that have restrictions on their operations. I mean, they will come to you as you are the landlord and ask, I mean, how you can help them out, and those are obviously discussions that you need to have, and you have, and to some degree, it's really a question of ensuring that these tenants actually survive the crisis. So I mean, so at the end of the day, it's a question of to which extent can you actually kind of like, I mean, alleviate their situation and make sure that they're able to survive and still operate. I mean, once you come out the other end.
Yeah. Laura, do you think operating companies, asset-light operating companies with no physical assets, are they a more or less attractive investment proposition now compared with a year ago? And would you consider investing in a pure operational platform?
So I'll take the last question first. We would consider investing into an asset-light platform if it provided an additive to one of our platforms, for instance, whereas we don't as a standalone investment, and unless there is a secured pipeline associated with it. I do think so. Generally speaking, I think there are attractive opco opportunities out there, because there have been players that have created concepts and ideas, and you know, there's great management competency in some of these opco platforms, and if the crisis led to a situation in which they need capital to move forward, and everything lines up in terms of, you know, product, strategy, business plan, and credibility, and yeah, I think they remain attractive. And you know, it depends on what type of buyer you are and what you're looking for. There'll be a lot of opcos that are in distress, but you have to differentiate as to whether or not they're in distress through their own fault, and you know, whether or not there is a repositioning effort or just a capital injection that can correct that, or whether or not there's something fundamentally wrong, in which case, you know, it depends on what sort of investor you are and what you're looking for. And then there are some opcos out there that we've been speaking to pre-COVID, during COVID, and after COVID, and we're hoping that at some point in time we can work out a structure that works for both sides, because they just have something that's great that we want to get our hands on. So.
Yeah. Thanks, Laura. Will, going back to the sector agnostic outlook, are there any markets or asset classes that you would consider investing in now as a result of the last year that you haven't been in before?
That's a good question. I'm
going to ask you all that question as well, so you better get your thinking caps on.
Yeah, you guys got time to think about it. I mean, we've always looked at all sectors, so I wouldn't say that anything is kind of off the cards or has changed. I mean, you know, similar to other sort of private equity groups, you know, on this panel and elsewhere, you know, if anything, you probably focus more of your energy into kind of the very sort of sectors that are struggling in the middle of the pandemic. So, you know, we spent more time looking at, you know, hotel owner operators as an example, to see if there's, you know, ways to kind of collaboratively refinance businesses and whatnot. We've looked at student developments, as I mentioned earlier. Again, where people might just think, you know what, I'm happy to sell out, and they can roll it into their next development, and you can take the operating risk over the next few years type thing. So if anything, it sort of focuses you on focuses us at least on the kind of sectors that are believed to be sort of challenged. And actually, we've got a bunch of retail assets that have actually performed remarkably well through COVID and have actually grown income. So again, sometimes it's spotting, blighted sectors and kind of, understanding the nuances. So for example, we've got a convenience retail shopping center up in Northeast London, Zone 4. It's done phenomenally well through COVID, because there's been a ton of people around there living at home every day and spending money around there. So yeah, if anything, it's just making sure you haven't completely disregarded sectors and have actually challenged yourself to look at kind of ideas that might be slightly against the grain.
Niklas, how about you? Have you cast your eye over anything that you haven't invested in before as a result of the last year or so?
Not really. I mean, we have a number of different platforms. I mean, all in one shape or form. I mean, relate to living. I mean, we have student housing, we have co-living, we have care, senior housing, and branded residential assets. I mean, and what we've seen throughout the pandemic is that we've actually, picked up speed on all of these. So we were actually, accelerating the number of or the pipeline, or the number of assets that we have in the pipeline, and the deals that we're making. We have not slowed down on offices. We have definitely not slowed down on logistics. I mean, quite the contrary. We actually sped up on that one as well. I mean, we were not, that big in retail before this, and to some extent we probably, pull the brake a bit on the retail, but then again, there haven't been that many opportunities coming up on that front either. But there are no asset classes that we didn't do at all before the pandemic that we've all of a sudden now have entered into the fold as such. Yeah.
Henri, are you guys considering anything outside of your normal areas of business?
No, I think it's similar to what Laura said. So I think well, first of all, I think maybe our focus has been now, as I told them at the beginning, we kind of half leases, half owned real estate. I think our shift has been much stronger now. Our focus is nearly solely on buying real estate at the moment, just because we think there will be opportunities to grow our platform, and in the end our shareholders is a real estate private equity, and so they want to, like a lot of funds have a lot of dry powder, and they want to deploy, thanks to the platform, money into that space. So that's been our focus and continues to be our focus. But that said, I think, like Laura said, if the an interesting opco platform comes along that nicely folds into ours, and where we see complementarity, etc., then I think we've been looking at different opportunities, but until now not the one where we said it's a really good match, or where the portfolio really combines well with ours, maybe too much overlap, etc. So we're open on both fronts at the moment.
Yeah, thanks, Henri. I mean, Laura, I guess Brookfield are across most sectors already, so there's probably not a whole lot of new stuff out there, but has anything cropped up that surprised you?
Yeah, as you said, we had a foot in almost all of the asset classes already. There are some that we're very bullish and aggressive on, like logistics and student housing. I'd love to get my hands on more hotel and hospitality investments. And so the only thing I would say that has changed is that, knowing now 2019 has reshaped a new definition of peak. So post GFC 2019 was our peak, and many asset classes have benefited from that. So it's going to take some time to get back to these levels, but that also means that if the pricing is right, you have recovery on your investment horizon as a lever that you can potentially factor into underwriting. And so nothing of this is particularly new or revelatory, but for us as investors, you know, in years running up to COVID, like we wouldn't have looked at resort style operations, or for instance, classic corporate MICE hotels or regional UK portfolios. That just wasn't working for us from a pricing perspective, and they had already, like most asset managers and capital partners, had already maximized everything in the book. So we're hoping that that there is, you know, a one or two or a couple more opportunities for us in that space for the next, like in the next couple of months.
Thanks, Laura. I've just noticed we've actually overrun our allotted hour, so I'm going to just run through a couple of very quick slides before thanking our fantastic panel. The next webinar is on April the 7th, and it's about technology and real estate. We've got a fantastic panel there, as you can see, and I believe the link to register for that one has just appeared in the chat. So this session is a forerunner to the Urban Living Festival, which is taking place in London in July. There you can see our fantastic list of sponsors and media partners, and we've just had a couple of new sponsors come on board actually in the shape of House and Garden and Oak North Bank, so welcome to those guys. If you're interested in getting involved and sponsoring the event, please get in touch with my colleague Katie. Her contact details are there. We're across all the social platforms for Urban Living Festival, so please do follow us and join the conversation there. Thanks to Cinevision for sponsoring the session today, and to Res Harmonics for sponsoring the webinar series. Thanks to Laura, to Niklas, to Will, and to Henri. Thanks to you all for watching, and I hope to see you on another webinar soon. Have a great day, everyone.